The most dangerous number in the world right now is not the inflation rate. It is not the interest rate. It is this number, $325 billion. This is the amount of cash Warren Buffett is currently hoarding at Berkshire Hathaway. To put this into perspective, Warren Buffett has enough cash to buy the entire country of Portugal and still have billions left over. While the news tells you that the S&P 500 is hitting all-time highs, and everyone on social media is telling you to buy the dip, the smartest man in the room is doing the exact opposite. Warren Buffett has just dumped half of his Apple stock. He dumped Bank of America. He is liquidating his portfolio at the fastest rate in his entire career. Why? Why is the Oracle of Omaha running for the exit while regular people are blindly buying? The answer is terrifyingly simple. He sees a storm coming that will make the 2008 crisis look like a warm-up. To understand the danger, we need to look at a metric that has predicted every major crash of the last century. It is called the Buffett indicator. It measures the total value of the stock market compared to the U.S. economy's GDP. Let's look at history. In the year 2000, right before the dot-com bubble burst, this indicator hit 140%. People said it was a new era. They said tech stocks would only go up. Then the bubble popped, and the Nasdaq lost 78% of its value. Fast forward to 2008. The indicator hit 110%. We all know what happened next. The global financial crisis. Banks collapsed and millions of people lost their homes. Now, look at today. The Buffett indicator isn't at 110%. It isn't at 140%. It is hovering near 200%. We are mathematically in the most expensive stock market in human history. The economy is not growing fast enough to justify these prices. It is like a balloon that has been inflated too much. It doesn't need a needle to pop. It just needs time. But let's go back even further. Let's look at 1929, the Great Depression. Back then, they called it the Roaring Twenties. Everyone was getting rich. Taxi drivers were giving stock tips. It felt like the party would never end. But if you overlay the stock chart of 1929 on top of today's market, the pattern is nearly identical. First, a massive run-up, then a small dip, then one final parabolic explosion upwards before the cliff. We are currently in that final explosion. Investors are suffering from recency bias. They think because stocks went up yesterday, they will go up tomorrow. But in 1929, the people who bought the top didn't recover their money for 25 years. Imagine investing your life savings today and having zero profit in the year 2050. That is the risk you're taking right now. But the stock market is just the tip of the iceberg. There is a bigger bomb ticking in the background: commercial real estate. Since the pandemic, the world has changed. Work from home is the new normal. Downtown office buildings in San Francisco, New York, and Chicago are sitting empty. Who owns these empty buildings? The regional banks. These banks are holding trillions of dollars in loans for buildings that are now worthless. When these loans default in 2026, the banks will collapse. And when banks collapse, credit freezes. Businesses can't get loans. Employees get fired. This spiral causes a recession. This isn't a theory. It has already started. We saw Silicon Valley Bank fail. We saw First Republic fail. Those were just the first dominoes to fall. If you still think everything is fine, just look at the actions of the people who run the world. It is not just Warren Buffett. Jeff Bezos has sold billions of dollars of Amazon stock. Mark Zuckerberg is selling Meta stock almost every day. The Walton family is selling Walmart. Even Jamie Dimon, the CEO of JP Morgan Chase, sold shares for the first time in history. Think about it. These are the insiders. They see the real sales data. They see the real consumer spending before you do. If they believed their companies were going to grow in 2026, they would be buying, not selling. They are cashing out their chips at the top of the casino, leaving retail investors, people like you and me, to hold the bag when the house of cards finally comes down. So, the trap is set. The Buffett indicator is flashing red. The 1929 pattern is repeating. And the billionaires are leaving the building. Does this mean you should sell everything and hide cash under your mattress? Absolutely not. That is fear, and fear keeps you poor. Warren Buffett isn't holding cash because he is scared. He is holding cash because he is greedy. He knows that when the crash comes, high-quality stocks will go on a 50% discount sale. He is preparing to buy the dip of a lifetime. And you should too. But you can't buy the dip if you lose all your money in the crash. You need a system, a mathematical approach that protects your downside while capturing the upside. I spent weeks backtesting a strategy called Modified DCA that actually beat the market during the 2000 and 2008 crashes. You do not need to guess. You do not need to gamble. Click this video right here on the screen, and I will show you exactly how to turn this coming crisis into an opportunity. I'll see you there.